anybody who doesn't know already, Jason Trennert is here, longtime friend of the show, so you probably do know who he is.
Longtime bear.
If you don't know, it's chairman and CEO of Strategas Research Partners, which is a Baird company. And Jason, you have been bearish for a long time. Your concern at this point is that it's higher interest rates that's really putting pressure on the markets
listen,
right now.
we got bearish last March of 2022, and I would say we stayed bearish this year, but largely, I would say, for the wrong reason, because we were expecting a recession. Now, we also, I have to say, we did expect, I do think inflation's sticky. I think there are elements of inflation that are structural, which means that long-term interest rates should stay higher. So we got that part right, but I have to say on the economy part, the economy is still, especially if you look at the labor market, you have claims at 201,000, unemployment rate still at 3.8%. So there's still tightness in the labor market, which is important for the Fed because that is a big input into the way they look at inflation and interest rates.
Well, look, we spoke with someone earlier who just pointed out that the JOLTS rate is not the same, that's seen some impact where you don't have people as willing to quit. And that's an indication that maybe the job market's getting a little tighter.
It should get tighter. It should get tighter because profit margins have been under pressure for 3 quarters in a row. I mean, one of the things that people have talked about, it's a theory, is that there's been some job hoarding on the part of companies, which is to say that despite the fact that profits have been down, albeit modestly, normally companies would lay people off if margins were under pressure. This time, it's been so difficult to hire people out of the pandemic that they're holding on to them. They're saying, like, well, gee, it was so hard to get these people in the first place. We're going to hold on to them. We want to see, we're going to have to see real pain and profits before we let people go. Now, you might be getting to that point where quarter after quarter, if that starts to happen, you start to make different choices.
So what does that mean you are? You think that we're going to, if we're getting to that point where companies are willing to actually start firing people because margins are getting squeezed, which some people think we are, second half of this year, is that good news or bad news? Do you want to see a labor market that is a little looser, and so then you don't have the Fed continuing to raise rates, and you don't have the same sort of pressure on wages? Is that what you're kind of advocating for? Is that good news?
It's tough because if you get markets don't do well in recessions. Okay, so sometimes there are profit recessions without there being economic recessions, but it never goes the other way around. If you have an economic recession, you always have a profit recession, and markets get tagged. So what you're hoping for, of course, is the proverbial soft landing, where you slow it down just enough so that the Fed doesn't have to tighten that much more, or it can actually start to ease. The issue, though, is I do think there are changes in the labor market and the global economy that mean that inflation could stay higher for longer, even if the economy slows. I think you've had an end to globalization, which I'm convinced is going to keep prices higher. You have environmental policies, in my opinion, that are keeping energy prices higher for longer. And then you have a federal government that's running budget deficits of 5 to 6% of GDP without any sort of idea of what the consequences are. And 65% of government spending is indexed to inflation. So in some ways, the Federal Reserve is fighting the federal government to get inflation down. And so even if the economy slows, the hard part might be that Fed funds rate stays high, or that interest rates stay high. And that will be a challenge for investors. It does suggest that you want to be more towards companies that are providing profits, cash flows. You want to stay away from the long duration assets.
The 10-year really is at 4.5 now. I just thought it is at above 4.5. So I'm trying to figure this out. You were wrong for the wrong reason. Does that make you feel better than if you had been wrong for the right? And if you were wrong about the wrong reason, does that mean you were right?
No.
Two wrongs don't make a right. So I'm all confused.
No. I think, listen, the fact of the matter is, I have to say, Joe, I still think the chances of recession are pretty high. I mean, simply because I've never...
Well, it just means the Fed's got to even go further to cause a recession, which is still playing into your negative scenario.
Yeah, I mean, I think so. I mean, I think I would have expected to see one now, but right now, if you look at this thing called the Taylor rule, a very wonky thing, but Taylor rule would suggest if you want to get inflation to 2, you have to get the Fed funds rate to 8.5. Now, That's not going to happen because we're going into an election year, and the Fed wants to remain independent, and the Fed would be a department of the Treasury Department.
We want to remain independent, so we're not going to do what's going to make you mad. So that we're not going to do what we would like to do, which will make you mad.
I think you've been right for the wrong reason.
I've been right for the wrong. Maybe that's right. Yeah, maybe
that's what.
Yeah, I'll take it. I'll take it.
I think I wouldn't question that because you did say. I mean, I pushed you pretty hard. You stuck to your guns. You never. Through the town.
Yeah, we're trying.
Well, it's not.
No victory lap here.
No.
We still got plenty to.